Greetings. Welcome to ABM Industries Incorporated First Quarter 2026 Earnings Conference Call. At this time, all participants will be in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. Please note this conference is being recorded. I will now turn the conference over to Paul Goldberg, Senior Vice President, Investor Relations. Thank you. You may begin.
Good morning, everyone, and welcome to ABM's First Quarter 2026 Earnings Call. My name is Paul Goldberg, and I'm the Senior Vice President of Investor Relations at ABM. With me today are Scott Salmirs, our President and Chief Executive Officer, and David Orr, our Executive Vice President and Chief Financial Officer. Please note that earlier this morning we issued our press release announcing our First Quarter 2026 financial results and outlook. A copy of that release and an accompanying slide presentation can be found on our website, abm.com. After Scott and David's prepared remarks, we will host a Q&A session. But before we begin, I would like to remind you that our call and presentation today contain predictions, estimates, and other forward-looking statements. Our use of the words estimate, expect, and similar expressions are intended to identify these statements, and they represent our current judgment of what the future holds. While we believe them to be reasonable, these statements are inherently subject to risks and uncertainties that could cause our actual results to differ materially. These factors are described in the slide that accompanies our presentation as well as our filings with the SEC. During the course of this call, certain non-GAAP financial information will be presented. A reconciliation of historical non-GAAP numbers to GAAP financial measures is available at the end of our presentation and on the company's website under the Investor tab. And with that, I would like to now turn the call over to Scott.
Good morning, everyone, and thank you for joining us to discuss ABM's first quarter fiscal 2026 results. We're off to a solid start of the year. We delivered 5.5% organic revenue growth, generated nearly $50 million in free cash flow, and repurchased over $90 million of shares in the quarter. While margin performance in Technical Solutions was below our expectations, primarily due to project timing and mix, underlying demand and backlog trends are healthy, and the fundamentals across the portfolio remain constructive. As such, our full-year outlook is unchanged. Let me step back and provide some broader context. Across our end markets, demand remains generally healthy. In prime office, recent data from CBRE indicates improving transaction volumes and stabilization in Class A vacancy trends in major gateway markets. While certain regional markets remain slower to recover, the flight to quality dynamic continues to favor the types of assets where ABM is concentrated. Our B&I segment grew 4% in the quarter, the highest it's been since the third quarter of 2022, reflecting strong international growth, stable client retention, and underlying steady demand. In aviation, TSA checkpoint volumes remain resilient, and airport infrastructure investment continues at elevated levels. The FAA's terminal modernization programs and large-scale capital projects across major U.S. airports support a multi-year pipeline of outsourced service opportunities for us. Our aviation segment grew double digits year over year, and our bid pipeline remains healthy. M&D continues to benefit from secular growth tied to major U.S. infrastructure and technology build-outs. Public and private investment in semiconductor manufacturing is accelerating, with a recent PwC forecast indicating that more than $1.5 trillion in fabrication facility investment through 2030 as AI, cloud, and edge computing drive demand for advanced chips. This underscores the scale of the opportunity and the multi-year runway it creates for service providers like ABM. With the completion of our acquisition of WGNSTAR at the beginning of Q2, we have meaningfully strengthened our presence in semiconductor fabrication environments and enhanced our ability to support this strategic U.S. growth area. In Technical Solutions, The secular tailwinds remain intact. Wood Mackenzie projects the U.S. microgrid market will more than double by 2030, driven by electrification, grid resiliency needs, and decarbonization priorities. At the same time, investments in data center construction and hyperscale capacity expansion remain robust as enterprises build out next-generation infrastructure to support AI and digital transformation. These trends align directly with ABM's strength in energy resiliency, engineering services, and mission-critical operations, and we expect ATS to deliver sustainable long-term growth as these markets continue to expand. In education, demand remains steady and resilient, given the essential nature of services provided to K-12 districts and higher education institutions. We continue to see opportunities as schools evaluate outsourcing to improve efficiency and service quality. Our focus on higher education, particularly large universities and multi-campus systems, positions ABM well in a segment where scale, complexity, and compliance requirements favor sophisticated multi-service providers. Now turning back to the quarter. The investments we've made over the last few years in sales resources, technical talent, and strategic contract positioning are clearly contributing to our growth trajectory. Not only do we grow organically in each segment, but our enterprise organic growth rate of 5.5% was the strongest we've delivered since the fourth quarter of 2022, when the business was truly emerging from the pandemic. From a margin perspective, our first quarter shortfall was predominantly concentrated in technical solutions. As we've discussed, ATS is inherently project-driven and can vary from quarter to quarter. Q1 was impacted by project timing and service mix, along with some weather-related delays. These factors created approximately 5 cents of EPS pressure relative to our internal expectations, with the majority attributable to delayed revenue recognition rather than reduced demand. Importantly, B&I and M&D performed largely in line with what we outlined in our third quarter call last year, reflecting the economics of newer contracts that ramped last year and provided immediate growth opportunities as we work more upward over time. Our ability to improve our margin profile can be seen clearly in education, where we once again delivered strong execution and meaningful expansion in margins. Switching gears briefly to AI, which continues to be a highly topical and source of so much volatility in the market. We believe AI will enhance ABM's capabilities rather than disintermediate our core services. The majority of our janitorial and engineering work takes place in dynamic, non-standard environments such as offices, airports, schools, stadiums, and industrial facilities, where layouts, traffic patterns, compliance requirements, and client expectations continuously evolve. These conditions require human judgment, dexterity, and real-time adaptability. That said, we're actively researching and testing a wide range of AI-enabled robotics, including emerging humanoid platforms. While robotics can add value in structured applications such as open area floor care and certain repetitive tasks, today's technology is not positioned to operate at scale across the full breadth of our service environments. As innovation continues, we expect robotics to become an increasingly useful complement to our workforce. At the same time, we've been investing in AI-driven predictive maintenance, intelligent scheduling, optimized routing, and back-office automation. These initiatives are already driving incremental improvements in labor efficiency, win rates, and SG&A productivity, and we expect benefits to expand as adoption increases and deepens across the organization. In short, we believe AI strengthens our business, not disintermediates it. In closing, we're encouraged by constructive demand across our markets. At the same time, Macro sentiment remains unsettled given evolving policy direction and geopolitical dynamics. Despite that, we are maintaining our full-year outlook and will continue to operate with discipline and focus. With that, let me turn it over to David.
Good morning, everyone. Let's start on slide 6. Revenue grew 6.1% year-over-year to $2.2 billion, driven by 5.5% organic growth and a modest contribution from our acquisition in Ireland completed last year. The WGNSTAR acquisition closed after quarter end and will be included in our Q2 results. As Scott mentioned, consolidated organic growth was the strongest we've delivered since Q4 2022 and broad-based across the portfolio. Aviation led the way with organic growth of 10%, while Technical Solutions and Manufacturing and Distribution both grew 7%. B&I and Education delivered 4% and 2% growth, respectively. Overall, we're pleased with the growth trajectory of the business, and our end markets remain constructive as we move into the second quarter. Turning to slide 7. Net income from the quarter was $38.8 million, or 64 cents per diluted share, compared to $43.6 million, or 69 cents per share in the prior year period. Adjusted net income was $50.4 million, or 83 cents per diluted share, versus $55.3 million, or 87 cents per diluted share a year ago. These year-over-year changes primarily reflect lower segment income, most notably in Technical Solutions, and higher tax expense and interest expense, partially offset by lower corporate costs. Segment operating margin was 7.1% compared to 7.6% last year. The year-over-year change primarily reflects unfavorable project timing, including some weather-related delays, and service mix within Technical Solutions, as well as by the margin impact of contracts that came online last year in M&D and B&I that we discussed in the third quarter. These factors were partially offset by strong execution and margin expansion in Education. Adjusted EBITDA was $117.8 million compared to $120.6 million in the prior year. Now let's turn to segment performance, beginning with slide 8. B&I revenue was $1.1 billion for the quarter, up 4% year-over-year. Growth was driven by higher work orders, strong performance in the UK, and the benefit of price escalations. Market conditions remain largely consistent with last quarter, and we expect modest, steady growth in 2026. However, growth is expected to moderate in the back half of the year due to the anticipated exit of a large UK client, as the contract's economics were no longer aligned with the long-term opportunity. Operating profit was $79.7 million, and margin was 7.5%, as compared to $79.4 million and 7.8%, respectively, last year. The margin change primarily reflects shifts in contract mix, along with increased investments in sales resources to support long-term growth. Aviation revenue grew 10% to $297.7 million, supported by healthy global travel demand and the continued ramp of several new contract wins. Operating profit was $12.6 million, with a margin of 4.2%, compared to $12.2 million and 4.5% last year. Profit and margin were modestly pressured by incremental weather-related costs during the quarter, which drove higher labor and supply expenses. As we noted last quarter, the large passenger services contract we secured at Heathrow Airport is expected to begin ramping in the second quarter, reinforcing our confidence in strong organic growth for aviation in 2026. Turning to slide 9, M&D generated $422.3 million in revenue, a 7% increase year-over-year. This strong organic growth was driven by recent contract wins, particularly in the technology sector, along with continued client expansions across the segment. Based on the momentum we saw over the last few quarters, we believe these growth rates are sustainable as we move throughout 2026. Operating profit was $36.3 million, with a margin of 8.6%, compared to $39.4 million and 10% last year. As discussed previously, the margin change primarily reflects the mix of newer contracts secured last year that provide meaningful long-term growth opportunities. Margin was also impacted by continued investments in technical sales talent and sector-specific capabilities. Education rose 2% to $228.7 million, supported by escalations and stable retention rates. The segment delivered strong operating performance, with operating profit increasing 54% to $21.6 million and margin expanding 320 basis points to 9.4%. This improvement was driven by enhanced labor efficiency, effective escalation management, and some temporary operating benefits related to severe winter weather in certain regions during the quarter. Looking ahead, we remain encouraged by the education pipeline and are actively pursuing several attractive opportunities, including a potential large award from a major school district in the Midwest. Technical Solutions, which, as we've discussed in the past, can vary quarter to quarter given its project-based nature, experienced a challenging quarter driven primarily by temporary project timing and service mix dynamics. First quarter revenue was $229.7 million, up 14% year over year, including 7% organic growth and 7% from acquisitions. Organic growth reflected strong activity in our mission-critical and data center markets, while microgrid growth was lower than anticipated, primarily due to the impact of temporary project delays, totaling approximately $20 million in revenue. A significant portion of these delays were weather-related, as severe conditions across much of the U.S. slowed construction activity. In fact, one of our larger customers temporarily suspended construction operations during the quarter. We're also monitoring potential impacts from the February storm in the eastern U.S., though it's too early to quantify any effect. Importantly, these delays reflect timing rather than demand. We expect the majority of these projects to resume as weather conditions normalize and move further into our seasonally strong second half. Operating profit was $8.4 million, with a margin at 3.7%, compared to $16.6 million and 8.2% last year. The margin decline primarily reflects adverse service mix within our microgrid business, as well as the impact of delayed project completions. In the prior year quarter, we completed a higher volume of engineering-heavy work, which carries structurally higher margins and did not repeat in Q1 of this year. Additionally, while revenue recognition was delayed on certain projects, our labor and material cost structure remained largely intact during the period. Looking ahead, we remain confident in the underlying demand environment. As projects progress through the pipeline and timing normalizes, we expect service mix to improve. Historically, ATS performance strengthens meaningfully in the second half of the year, and we expect fiscal 2026 to follow a similar seasonal pattern. Now, turning to slide 10. We ended the quarter with total indebtedness of $1.7 billion, including $23 million in standby letters of credit. Our total debt to pro forma adjusted EBITDA ratio was 2.9 times. Available liquidity stood at $608 million, including $100 million in cash and cash equivalents. Of note, our leverage ratio will be above 3 times in Q2, driven by the WGN-STAR acquisition. We expect to work it back down to under 3 times by the end of our fiscal year. First quarter cash from operations was $62 million, and free cash flow was $48.9 million, representing a significant improvement over the prior year. This performance was driven by strong working capital management efforts and continued progress in our ERP stabilization in the quarter, positioning us for a more normalized cash flow in 2026. Now, turning to capital allocation. During the first quarter, we repurchased 2.1 million shares at an average price of $44.13 for a total cost of $91.1 million. At quarter end, $92 million remained under our existing authorization. As always, we balance deleveraging with incremental repurchase activity and opportunities within our M&A pipeline to drive long-term value creation. Interest expense in the quarter was $24 million, up $1.1 million from last year, reflecting larger average debt balances driven by our first quarter share repurchases. Turning to our fiscal 2026 outlook on slide 11, as Scott noted, while we feel good about the relative health of our end markets, we remain mindful of broader economic uncertainty. Accordingly, we're maintaining our previously communicated fiscal 2026 outlook. As a reminder, we expect full-year organic growth of 3 to 4%. Aviation, M&D, and Technical Solutions are expected to grow above that range, while B&I and Education are projected to deliver low single-digit growth. The WGN-STAR acquisition is expected to deliver approximately an additional 1 point of revenue growth, bringing total growth to 4 to 5% for the year. Segment operating margin is expected to be between 7.8 and 8% for fiscal 2026, with margin expansion weighted towards the back half of the year as project timing normalizes in Technical Solutions and seasonal patterns reassert themselves. Interest expense is forecast to be $95 to $105 million, and our normalized tax rate before any discrete items, including the possible extension of the Work Opportunity Tax Credit program, is expected to be 29 to 30%. Our cash flow expectations are also unchanged. We continue to expect free cash flow of approximately $250 million in 2026 before the impact of transformation and integration costs, the RavenVolt earnout, and any incremental restructuring. Putting it all together, we continue to expect full-year adjusted EPS to be in the range of $3.85 to $4.15. And as a reminder, our outlook does not include any future positive or negative prior year self-insurance adjustments. Going forward, we'll continue to highlight any material impacts resulting from the inclusion of prior year self-insurance adjustments in our non-GAAP results. With that, I'll hand it back to Scott for closing remarks.
Thanks, David. In closing, we remain confident in ABM's trajectory. We are growing organically. We are generating cash. We are allocating capital decisively. We've strengthened our semiconductor capabilities through WGNSTAR, and the long-term trends across energy resiliency, airport modernization, and prime office stabilization remain supportive. At the same time, we're focused on improving consistency within Technical Solutions and executing with discipline across the enterprise. I want to thank our more than 100,000 team members around the world. Your dedication and professionalism continue to differentiate ABM and position us for long-term success. With that, let's open it up for questions.
Thank you. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. We ask that you please limit to one question and one follow-up question. Our first question is from Tim Mulrooney with William Blair. Please proceed.
Yeah, good morning, Scott and David. It looks like margins were impacted by several things here, including project timing and service mix. So I have a few questions on each of these, and I know you touched on them in the prepared remarks, but just want to double click on, first of all, the project timing. Was this primarily just a weather disruption issue, or were there other factors such as project rework being done? Because, weather issues, those are more isolated, but projects taking longer to complete or, if there's rework being done, that kind of stuff can bleed into future quarters. So I just want to double check on what drove that underperformance in the quarter.
Yeah, thanks, Tim. Look, you were around, you saw the weather, right? And, it was a tough quarter from a weather standpoint. So, as it relates to ATS, you think about our Q4, which was really strong. The fundamentals continue to be good in ATS. And this is just really about a delay and really pushing to the right rather than canceling projects. So this is all stuff that'll be worked back into our numbers a little bit in Q2 and the predominance in the back half of the year. But, we feel really good about ATS, But listen, I have to say, Tim, we're dealing in the realities of the economic uncertainty that we have between some of the macroeconomic issues and the geopolitical issues. So it's Q1 now. We still remain confident, but, we're cautiously optimistic, but there is some caution there, just like pretty much every company that's reported have been hearing the constant theme about this uncertainty. So we're not immune to that. But as we sit here today and we think about ATS, we feel really good about it.
Yeah, you're certainly not the only company, Scott, to be talking about weather-related issues in the fourth quarter or, macro uncertainty. So I think everyone definitely understands that. I wanted to make sure there wasn't anything else beyond weather. It sounds like there wasn't. So that's good. And I guess if I'm going to ask one more question, margins were a little lower than expected in the first quarter, but you maintained guide for the full year. So can you just help, because it makes it feel like it's a little more back half weighted now. Can you just help me understand that expected trajectory or cadence as we move through the fiscal year here, just for, so we can update our models accordingly? Thank you, Scott.
Yeah. Hey, Tim, this is David. I'll jump in and grab that one. Appreciate the question. So I think the predominance of that shift you can tag to ATS specifically. So, and for perspective, in our U.S. ATS business, over the last 3 years, about 2/3 of the operating profit has been delivered in the second half of the year, and there's been a 350 basis points margin improvement from first half to second half in that group, and that's just purely a seasonal item with that business, and it's been very consistent. I would say we don't expect that to change to be any different this year. And I think the other element to that is in the B&I and M&D world, we spoke about some of the contracts that we renewed and brought on last year in the third quarter. And, one of the things we talked about was the margin trajectory over time in those groups. That doesn't happen overnight, obviously. But as we go throughout the year, and specifically the back half of the year for those groups, we anticipate some of the labor optimization projects kicking in for those contracts and other cross-sell opportunities. So it gives us a little bit of a glide path on margin improvement for those groups as well in the back half of the year.
Understood. Thanks, David.
Our next question is from Jasper Bibb with Truist Securities. Please proceed.
Hey, good morning, guys. I was hoping you might give a little bit more detail around B&I customer behavior. I guess I'm wondering, are you seeing any change in the office occupancy indicators like special events volume? And have you also seen any more customers coming to you and looking for pricing concessions or anything like that after the experience of a couple quarters ago?
Yeah, so we haven't seen anything yet on scale with customers because of the economy. But look, again, as I stated before, it's Q1 and we're remaining conservative. But for now, it's been stable. It's really been stable. And some of these things have a delayed effect, right? But for now, we feel good about it. As it relates to B&I, we'll have a little bit of organic revenue pressure in the back half. We had a large contract in London with the Transport for London that's rolling off. That's going to have an impact of about $70 million of revenue in the year. But the reason I want to bring that up is, I'm kind of proud of the discipline of the team because, we made some hard decisions in Q3 last year where we took on contracts at lower margin, but we did that because we knew that we can work those up over the contract period, and we saw a path to really good profitability over time. With this contract, the way it was structured and the way it was laid out, and we just didn't see a path to increasing margin. So we probably could have held on to that contract and made next to nothing and didn't have a good trajectory, and we weren't willing to do that. So it's one of those stories that, it's bittersweet. We hate losing a contract of that size, but again, really proud of the team for making a good decision on a contract that couldn't be worked up from a profitability standpoint.
Thanks for that. And then pretty healthy repurchase number this quarter. I just wanted to ask how you're thinking about balancing maybe the capital deployment piece and deleveraging over the rest of 26 now that the WGN Star deal is closed.
Yeah, Jasper, David, thanks for the question. I'll grab that one. So, obviously, we believe in the long-term prospects of the business and that the share will rise over time, and that was part and parcel of our decision to continue buybacks in the first quarter. And, for context, last year we repurchased over 100 million in shares. So, we took the opportunity this quarter to go ahead and cover dilution, plus roughly an incremental 60 million of share buyback on top of that. So all that being said, I think as you mentioned, the WGN Star acquisition, as we spoke about, will temporarily take our leverage over 3 times. And given that our target range is below 3 times, I think what you should expect in the near-term future is for us to use our free cash flow to delever back towards that range.
Got it. Thanks for taking the questions, guys.
Our next question is from Marc Riddick with Sidoti & Company. Please proceed.
Hey, good morning, everyone.
Morning.
Wanted to touch a little bit on what you're seeing as far as some of the market share gains that you've mentioned and some of the new business wins. Maybe talk a little bit about the competitive dynamic of what you're seeing in the segments, and if you've seen much in the way of a shift in the competitive dynamic over the last few quarters, whether it's driven by macroeconomic situations or if you're seeing any greater opportunities than maybe you were more recently.
No, we haven't seen any change, which is, I guess a positive sign. I think everyone's all behaving appropriately in the competitive set, and which is always a good thing. So I think it's been pretty stable, and we haven't seen any overreactions whatsoever with competitors or, frankly, even clients right now. I think everyone's kind of in pause mode. Everyone's watching and waiting. And that, again, the reason why we remain cautious, but still optimistic.
Okay, great. And then recently you made the announcement of the new business win of in Philadelphia with the Citizens Bank. I was wondering if you talk a little bit about what you're seeing on the leisure side of things, and how you're looking at that for this year. I know sometimes there can be a little bit of ebb and flow in leisure activity or concert activity. Maybe you could talk a little bit about what you sort of have embedded in your expectations for this year relative to what we've seen over the last couple of years on the leisure side.
Yeah, we're loving this segment. It's had really high growth. It's still a smaller percentage of our business, but it's growing. And I'll tell you, it's interesting, and I think we've seen this before. No matter how bad the economy gets or how uncertain, people are still coming out to see Taylor Swift, right? So we haven't seen a reduction in demand. As a matter of fact, we're even internally putting more focus on that group and actually giving it more of a national platform now in terms of how we're managing it. So we've become incrementally excited about the group and the trajectories. And I think it was, one of our bragging rights is I think we took care of the services in the last 5 Super Bowls, and we have the next one as well. So it's just a great segment for us.
Yeah, it's interesting you bring that up because you've made mention on the Super Bowl situation before, and kind of in the presser on the Citizens Bank, if I remember correctly, they've got a high level event of their own, which was sort of highlighted. So sort of curious as to maybe was one of the beneficiaries that you're seeing in new business wins in that area is being able to do high level events like that.
Yeah, you know what it is? It builds upon itself, right? Because so much of what we do is continual resume building. So you get a landmark account, and that helps you sell other accounts. And outside of even sports and entertainment, we talk about the fact that we're taking care of the majority of services. We're well over the Fortune 1000. I mean, when you look at our portfolio, and we've continually talked about and have been proud about the Class A nature of the work we do in B&I, in M&G, even in education. We like to brag, but we have a resume to die for.
Right, and the last one for me, I think when WGN Star was announced, there was a revenue contribution estimate based on 2025, but obviously the year hadn't finished yet. Is there an update on sort of where they finished 2025 revenue and how we should think about any seasonality, if anything, if any, in that contribution?
Yeah, no, thanks, no changes to the expectations for how they finished 2025 was right in line with what we thought. And in 2026, we're expecting roughly somewhere between $120 and $130 million of revenue. And, over time, we certainly believe this is a business that can have a double-digit growth profile and at a 15% EBITDA margins, like we mentioned on the previous call. It's a really attractive end market for us that we really think we can grow.
Yeah, I think Ravenbolt started out at about the same revenue, and we did over $400 million in business last year. So, when we make these strategic acquisitions in end markets that we believe are accelerating, the one thing I would say about ABM, we know how to lean into those end markets and build a business. So we feel like WCM Store is going to follow the same trajectory.
Okay, excellent. Thank you very much.
Thanks.
Our next question is from David Silver with Freedom Capital Markets. Please proceed.
Yeah, hi. Thank you. I wanted to maybe just ask you a couple of questions regarding maybe full year outlook. But last year was a record for your company for new business wins at, I think, $1.9 billion. And, your organic growth was kind of above your full year guide in the first quarter. So should we anticipate a new business win total greater, than last year's record? And if you wouldn't mind, where do you think you have the greatest confidence in, year-over-year growth? And overall, I guess included in that, I know there's some strategic contract bidding in the M&D sector, I believe, and just maybe some comments on the overall margin profile of your new contract wins that you expect or that's built into your guide for 2026. Thank you.
Yeah. So again, David, it's early on for us, right? It's still Q1, and we remain confident, and we look at our guide, and I'd say that we're internally we're forecasting to be on the higher end of that range, but it's early on yet. We do have a bunch of uncertainty, but we still feel really good about aviation is going to be strong, M&D is going to be strong. As I mentioned earlier in the call, I think B&I will temper a bit because of that larger contract in the UK. And ATS is going to be strong. It's a back half story, but all in all, we feel constructive across the board. And again, sitting here today, as we model, we think we're going to be towards the higher ends.
Okay, thank you for that. And, my next question is kind of a big picture question about labor cost and availability in the current, I guess, political, social environment. But, compared to 2 or 3 years ago, I think, the pool of workers that might be available for some of your cleaning and I'll just call it moderate skilled work, may be shrinking. And I believe most of the effects for ABM would probably be indirect as opposed to direct. But, has your overall business strategy changed at all, let's say over the last 2 or 3 years as a result of, maybe that structural change in immigration versus emigration? Thanks.
Yeah, that's a good question. We made a decision 2 or 3 years ago to move into our talent acquisition area. Made a lot of investments in technology in terms of how we onboard people, how we vet I-9s, how we do security background checks. And we've talked about that over the years, and it's really been helpful. The talent in our talent acquisition area has just been really upgraded, and we feel great about that. But I will tell you, just dealing a little bit more with the near term, sitting here a year ago, I had a very different feeling about how this is all going to play out versus where we are today. And frankly, David, I'm surprised. because we've not seen a deterioration in applicant flow. We have not seen a deterioration in the staffing levels on site. So we're optimistic that we don't see a catalyst right now that's going to change that, and it really hasn't affected any major wage pressure right now. Knock wood, things are going well on the labor front, and again, I'll say what I said a few seconds ago. Very surprised by that, especially from where we were sitting last year at this time and some of the narrative on immigration. So we're pleased.
Okay, great. If I could just sneak a quick one in, an additional one in. I did notice in your prepared remarks and in your slide there was a comment about ERP stabilization. And I remember or recall, kind of your approach to implementing or starting up that new ERP system. But just a couple of questions. But has it fully normalized? And then secondly, like when you do bring on new business, is there kind of a smaller but analogous, delay or extra care in ensuring that the billing is handled appropriately with new customers that might cause, aftershock, smaller, ripples of the same effect, let's say, during this year? Thank you.
Thanks, David. It's David. I'll take that one. So I think the good news is we continue every quarter to make progress on the stabilization from the transformation. And we have a very significant majority of the transactions from the entire enterprise on the new system. So the B&I, M&D groups, and the education groups are all on. And I think, so I'd couch it as we're in the 7th or 8th inning of this. And I think you see the results, particularly in the cash flow, right? Q1 cash flow was good, had some catch up from last year from a stabilization perspective. And so we anticipate, continuing that momentum. As far as new contracts that we bring on board, the way I would talk about the systems is almost like learning a little bit of a new language, right? So we kind of take care and time to make sure that any new business for the 3 groups that are on is loaded in properly, the data's vetted, analyzed. We do proof of billing before we send the first billing out. So it's a pretty rigorous process because it is, you make a first impression as you get a first bill out the door, and you want that to be right and accurate, and that flows right down to our cash flow success. So at the end of the day, we're pleased with the progress. Like anything, you can always improve, you can always be better, but we feel like we're in a good position now on the ERP.
Our next question is from Josh Chan with UBS. Please proceed.
Hi, good morning. This is Karan Singhani on for Josh. Thanks for taking our questions. So I wanted to ask about the education margins because it seems like margins in education has been really strong lately. So just wondering how sustainable that is and whether we should have similar levels of margins going forward as well.
Yeah. Hey, good morning, it's David. So, what I would say is we're obviously really pleased with where the education margin profile is. I think this quarter specifically, we had a roughly 50 basis points benefit from weather where we didn't have kids in school for a couple of days at the end of the month. And, some of that we'll give back next quarter just as makeup days come into play. But what I would tell you is, that team just done a really good job and, from just a managing all the direct costs element. And, we see a bit of a good trend there on the education margin side.
Yeah, and I'm so pleased with the leadership there. We had a reboot a couple of years ago with our senior leadership and our sales leadership, and we see some really good trajectory. We'll have a little bit of pressure in Q2 because the weather delays caused schools to close, and we had a little bit of benefit on the labor, but they have to make up those days. So we'll see a little bit of that in Q2 on the margin side as they make up the days when we have to put in some labor that was, previously unforecasted. But this has been a real good story for us on the education side.
Got it. Very helpful. And just maybe as a follow-up, I wanted to ask on like M&D and aviation. So it sounds like you're expecting still like strong growth going forward, but I'm just wondering if there are like any concerns as it relates to the geopolitical risks, maybe the oil price going up that could impact M&D customers and or funding pause for BHS if like that could be an issue for aviation segment.
Yeah, so aviation still remains really strong. Like we had a good quarter. We had a lot of project work in the Northeast that will start, trailing off a little bit, but the pipeline is really strong. We're leaning into integrated services across our aviation sector, and we're seeing no downside right now to travel. And even with oil prices, it seems to be coming down recently. We don't see that as an impediment in that group as we sit here today.
Okay. All right. Thank you. That sounds good.
Thank you.
Our next question is from Rohan Vasudeva with Baird. Please proceed.
Hey, it's Rohan on for Andy Whitman. Thanks for taking my question. I think most of my questions have been answered, but I wanted to ask on, M&D or aviation margins. You guys called out in the quarter that there were some new contracts ramping that you won last year. How long do you expect these new contract ramp headwinds to persist?
So with new contracts, I think I touched on this a little bit earlier, but like the way to think about it is when you take on a contract and you maybe, I guess the way to say it, when you compromise a little bit on pricing because it's a good strategic contract, the only reason you do it is because you see a glide path back to really good profitability. And that just doesn't happen overnight. That's something that happens over time as you get to learn the property and you get to figure out how you can adjust labor. So it's not kind of a binary thing where you get a contract at maybe at a discounted rate from where you'd like, and then 3 months later it's back. It's just something that happens over time. So it's from our perspective, it's not something that in Q2 or Q3 we're going to be able to call out. Now we will lap these in the back half of the year, so it won't feel as bad. But just generally speaking, when you get a contract and you're trying to work the margin up, it's a glide path that happens over the life of the contract rather than something that you fix in 30 or 60 days.
Got it. Thank you. And then my last question would be, is there any update on the restructuring process? What is the capture rate of the original $35 million you had expected at the start of the year?
Yeah. So, all the $35 million project was completed, initiated last year, completed last year. So we see the benefits of that kind of rolling through the first couple of quarters and into Q3 of this year. And, I would say, and Scott mentioned it, just given all the macro sensitivity, geopolitical risks, everything that's broad-based, the good news about ABM is we can control several things. We can control our labor on the direct basis, and we have a completely flexible labor model. And we also have, strategy playbooks and for SG&A cost mitigation and cost management, so that we're ready to deploy if we need to. So, it's just a diverse way to look at the business, and we have a real good sense of the leverage we have if there's any disruption.
Yeah, and just to add to what David's saying, we talked at the start of the call about the fact that there is some uncertainty out there. And, I want to make sure everybody on the call understands that we're just not admiring it. We have plans, we have mitigation strategies, and we have responsibilities. So that's something that's top of mind. And again, we're not looking at this from a passive standpoint.
There are no further questions at this time. I would like to turn the conference back over to Scott for closing remarks.
Thank you. And thanks everybody for taking the time to listen. I think you hear that we had some, thematic pressure with weather-related delays, but We feel really good about where we sit right now. We're optimistic, and we're excited to come back and talk to you in Q2. So thanks, everybody, and we'll talk soon.
Thank you. This will conclude today's conference. You may disconnect at this time, and thank you for your participation.